Good evening, everyone. I welcome all the participants to the second quarter 2018 earnings conference call of Rain Industries Limited. Speakers on today's call are Jagan Reddy Nellar, Managing Director of Rain Industries Limited, Gerard Sweeney, President of Rain Carbon Inc., and T. Srinivas Rao, Chief Financial Officer of Rain Industries Limited. During the call, management will be referencing and discussing a slideshow presentation, which is available for viewing on our website at www.rain-industries.com in the Investor Relations section. We recommend viewing this presentation while listening to management's discussion. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature that could be affected by certain risks and uncertainties. The company's actual results could differ materially from such forward-looking statements. Now, if you could turn to slide 3, I would request Jagan to provide an update on key developments within the Rain Group. Over to you, Jagan.
Thank you, Ryan. A very good evening to all the participants. The second quarter of 2018 witnessed a lot of uncertainties across the industry and market due to various geopolitical reforms. In spite of such turbulent conditions, Rain delivered a solid performance during the second quarter of 2018 by achieving a consolidated revenue of Rs 37.7 billion with an adjusted EBITDA of Rs 6.9 billion and a net income of Rs 2.9 billion. Each of these is an improvement compared with the same period a year ago, and as a result, earnings per share increased by Rs 4.3 in the second quarter of 2018 compared to the second quarter of 2017. Further, I am also glad to report that we have ended the second quarter with the best safety performance in the history of Rain. Safety will always be our top priority, and it is an area of continuous focus and ongoing investment. In fact, we created a new Vice President position for Safety, Health and Environment, or SHE, as we call it. We also are expanding our engagement with DuPont Sustainable Solutions to gain a better understanding of the strengths and gaps in our current safety culture and process safety management systems and to identify opportunities for improvement. From an overall market and industry perspective, sales volume and realizations improved. I also would point out that despite some investor concerns about lower volumes during the first quarter, our strategy of not pursuing sales at the expense of profitability is proving successful. As we will discuss later in the presentation, we protected our margins and profitability in the second quarter. We also saw some turbulence in the market as a result of tariffs imposed by the United States and environmental protection measures being implemented in China and India. Jerry will take you through these topics on the next slide of this presentation. Jerry?
Thank you, Jagan, and good evening, everyone. It's a pleasure to speak with you all again. Looking at aluminum production and demand, you will see on the chart in the upper left on slide 4 that the worldwide growth we have experienced since 2016 is expected to continue for the foreseeable future. In the chart to the upper right, we see the healthy performance in the LME aluminum price, which has been trading between $2,100 and $2,400 per ton for some time now. The continued decline in LME inventory levels has supported aluminum prices above $2,000 per ton for the last 6 months. The lower LME inventories and higher aluminum prices, coupled with moderating production levels in China, have led to several restarts in the United States, which I will discuss on the next slide. At the same time, the world is wary of high inventories in China and where these volumes will ultimately wind up in the future. Dumping of aluminum has garnered a lot of attention over the last few years in many countries and become the basis for protected tariffs. Moving to the lower left of this slide, you can see the fuel oil prices in the second quarter of 2018 continued the upward trend we have seen over the past few quarters. In fact, fuel oil prices at the end of Q2 were more than 40% higher than the same time last year. Now turning to slide 5. We continue to see accelerated growth in aluminum production in Asia and the Middle East. During the first half of 2018, Primary aluminum production was up 12.7% in Asia and 3.9% in the Middle East compared to the first half of 2017, and this time not dominated by China but India. The continued demand growth in Asian markets has created favorable market conditions for both our CPC and CTP products. By contrast, in China, production narrowed by about 1.4% in the first half of 2018 compared to first half of 2017. And we are seeing fewer than expected additions of new primary aluminum facilities due to governmental regulations, higher operating costs, weak aluminum prices, and excess inventories in China. We believe that if the Chinese aluminum producers are successful in removing China's export tax, they would then dump these excess inventories on the rest of the world. On the right side of the slide, you can see the estimated incremental production capacity being added in the United States. The restarts are the result of various geopolitical reforms implemented in the region, including a 10% import duty issued in country. In the most recent updates, Alcoa confirmed the restart of its 3 pot lines in Warwick, Indiana, and Century Aluminum confirmed that it has restarted one of 3 pot lines in Hawesville, Kentucky. These restarts have been slower than originally contemplated due to the availability of skilled labor and negotiations for power and alumina, causing concerns that the viability of these restarts and the key to their long-term survival. On the supply front, I want to take a moment to update you on the status of India's ban on imported petcoke. As you know, to help reduce industrial emissions, the Honorable Supreme Court of India issued an order in July of this year that attempts to ban, in part, the import of petcoke, our main raw material. The High Court ruled that it could be used only as feedstock or as a part of a manufacturing process. Essentially, the intent is to ban its use as a carbon-based fuel or coal substitute. At Rain Carbon, all of the green petcoke that we import to our Vizag facility is used as a feedstock for calcination. Also, the calcined petroleum coke we import for blending is used by the aluminum industry to manufacture anodes required in their smelting process. As a result, we do not expect to be impacted by these restrictions. Since the ban was announced, a number of industries, including cement, lime, calcium carbide, and gasification units, have received exemptions from the Honorable Supreme Court of India, allowing them to import and use petcoke. As a major importer of anode-grade green petroleum coke, which is different than fuel-grade petroleum coke, and as a major supplier of calcined petroleum coke that is used in the manufacturing process for aluminum, we have approached the Supreme Court for inclusion of calcination in the class of permitted industries to import and use petcoke as feedstock. Before we turn to the next slide, I want to take the opportunity to update you on the potential impact to our business due to the U.S. sanctions on Rusal. It is our belief that Rusal will comply with U.S. requirements and the sanctions will be lifted in due time. Despite recent articles in the news, we are indeed seeing signs of progress, such as the change in the composition of Rusal's board of directors. In the most recent proposal filed with the Office of Foreign Asset Control, OFAC, Mr. Deripaska has agreed to reduce his holdings in its London-listed entity to below 45% from around 70% currently. Rusal is an important customer to our Severtar facility, representing 37% of the plant's sales, but this is just 1.5% of our global sales revenue. While we certainly don't want to lose Rusal as a customer, if the sanctions do indeed go through, there is growing demand for coal tar pitch in the Middle East and throughout Asia, and we could easily move product from our plant in Chernobyl to these markets. Geopolitical actions such as import bans, sanctions, and tariffs can have an impact on our industry and our customers. However, our plants are of large scale and in proximity to transportation hubs to provide maximum flexibility in the markets we can access. We're constantly monitoring activities around the world, and we are prepared to act swiftly and responsibly as events warrant. Now let's turn to slide 6, addressing MARPOL. In 2017, the International Maritime Organization confirmed the application of new regulatory terms under MARPOL, limiting the sulfur content in marine fuels starting in 2020. This will require all marine fuels to be 1% sulfur or less and greatly impact the global refining complex. The enactment of these regulations will impact the existing production of green petroleum coke worldwide. However, it is too early to draw any solid conclusions on the exact impact it will have on our global GPC supplies. Once again, we are watching the situation closely, and we will keep you updated. We believe we are well placed to overcome any impact on availability of raw material for Rain due to our long-term relationships with suppliers, globally integrated facilities, and superior blending capabilities. On the positive side, MARPOL regulations will greatly benefit our petrofeed strategy in the distillation business. The restructuring of marine fuels means a likely glut of available heavy cuts from global refiners. This should mean more supply of very affordable feedstock in the distillation business. Now, Jagan will give you updates on our ongoing capital projects. Back to you, Jagan.
Thanks, Sherry. Last year, we announced two major capital projects, including a 370,000 tons per annum vertical shaft calcination plant at Vizag and the debottlenecking of our petrochemical distillation facilities in Europe. Preliminary project work began in 2017 on the vertical shaft calcination facility. We have obtained all the requisite permits and the work is progressing according to schedule. We expect to commission the plant and begin operations in the third quarter of 2019. The debottlenecking of our petrochemical distillation facilities has made substantial progress, and we estimate that this project will be completed on schedule in the fourth quarter of this year. During the second quarter of 2018, we announced plans to invest 60 million euro in a hydrogenated hydrocarbon resins plant at our facility in Qtr1, Germany. When completed in the third quarter of 2019, the plant will become the centerpiece of our new advanced materials business, producing whitewater resins designed to meet evolving regulatory and societal requirements for cleaner, greener raw materials. And speaking of advanced materials, I am pleased to inform you that we have hired Mr. Ralph Maxner to lead this crucial part of our business. Ralph comes to Rain Carbon from BASF and brings more than 30 years of global experience across the sales, marketing, and business development spectrum to this new role. It is a rare opportunity when a company can add someone with Ralph's breadth and depth of experience to its team. We are particularly excited about his global background and experience with battery technology, which will be crucial as we work to increase sales to the lithium-ion battery industry. Ralph also will play a key role in helping our commercial team establish new world-class standards and KPIs for measuring our performance, achieving commercial excellence, and uplifting segment performance. Finally, the company is undertaking technology upgradation of its existing cement grinding plant at Kurnool, Andhra Pradesh, India. With this technology upgradation, the existing cement grinding capacity will increase from 2.03 million tons per annum to 2.79 million tons per annum. This technology upgradation will enhance the production efficiency through savings in power consumption. The total estimated capex for this project is rupees 419 million or rupees 41.9 crores. The project is scheduled for completion by the end of Q2 calendar year 2019. Now Srinivas will update you on the financial position of the company. Srinivas.
Thank you, sir. A warm welcome to all the participants. Turning to slide 8, Rain is pleased to report improved performance during the second quarter of 2018 compared to the same period last year due to continuation of favorable market dynamics and positive impact from the appreciation of the euro and the US dollar against the Indian rupee. The performance of our advanced materials segment was weaker in this quarter, primarily due to an increase in the operating cost resulting from the appreciation of the euro. In the second quarter of 2018, Rain achieved consolidated revenue of 37.7 billion rupees compared to 27.1 billion rupees in the second quarter of 2017, an increase of 10.6 billion rupees or 39.3%. This resulted from 9.9 billion or 61.5% increase in revenue from our carbon business and 1.2 billion or 14.5% increase in revenue from our advanced materials business segment, which is partially offset by a 0.5 billion rupees or 16.4% decrease in revenue from our cement business segment. Turning to next slide on the carbon business performance. Revenue from carbon business segment was 26 billion rupees for the quarter ended June 30th, 2018 compared to 16.1 billion rupees for the same period last year, which we noted in the previous slide as an increase of 9.9 billion or 61.5%. This improvement was primarily due to a 48.3% increase in the average sales realization of all our carbon products, that includes a 12.5% or 4% appreciation of the euro and the US dollar respectively against the Indian rupee, coupled with an 8.9% increase in aggregate carbon product sales volume excluding energy. In the quarter ended June 30th, 2018, compared to the prior year quarter, revenue from calcined petroleum coke product increased by 68.8% due to an increase in the average price realization by 51.4%, including a 4% appreciation from the US dollar against the Indian rupee, coupled with an increase in sales volume by 11.5%. Coal tar pitch sales volume remained constant. However, revenue increased by 84.4% due to increase in aggregate average sales price by 84.4%, including a 12.5% appreciation of the euro against the Indian rupee compared to the previous quarter. Revenue from other carbon products increased by 30.8%, mainly due to an increase in aggregate average sales price at the rate of 20.1%, including 12.5% appreciation of the euro against the Indian rupee, coupled with an increase in aggregate sales volume by 8.9% compared to the previous quarter. Energy revenue in the quarter is increased by 1.9%. That includes a 4% appreciation of the US dollar against the Indian rupee as compared to the prior quarter. Turning to next slide on the performance of advanced materials. Revenue from our advanced materials business segment was 9.3 billion for the quarter ended June 2018 as compared to 8.1 billion rupees for the same quarter last year, an increase of 1.2 billion rupees or 14.5%. This increase was primarily due to a 14.5% increase in the average sales realization of our advanced materials, including a 12.5% appreciation of the euro against the Indian rupee. Engineered products revenue increased by 46% in the June 2018 quarter as compared to previous year due to an increase in aggregate average sales price by 31.9%, coupled with an increase in sales volume by 10.7%. Petrochemical intermediates revenue increased by 11.7% in the quarter June 2018 as compared to last year due to an increase in average sales price by 17.3%, partially offset by the decreased sales volume of 4.8%. Although sales volume remained constant in naphthalene, revenues increased by 6.9% in the quarter ended in June 2018 quarter as compared to last year due to increase in aggregate average sales prices by 6.9%. Similarly, resins revenue increased by 7.1% in the quarter as compared to last year due to increase in average sales realization by 11.3%, partially offset by decrease in the sales volume. Moving to slide 11 on the cement business. During second quarter of 2018, there was a mixed trend in sales volume in our cement business. There was an increase in volumes in certain markets such as Andhra Pradesh, Telangana and Kerala, and partially offset by decrease in volumes in Tamil Nadu, Karnataka, Maharashtra, Odisha, Goa and Pondicherry. Overall, our cement sales realizations decreased by 18.8% during June 2018 quarter as compared to last year, and they were partially offset by an increase in volume by about 2.9%. Due to these reasons, the revenue from cement business decreased by 16.4%, and EBITDA from cement segment decreased by about 44.5% due to increase in operating costs and lower cement clinker ratio. We are working towards reducing costs by various efforts, the largest of which was the installation of the waste heat recovery power plant at our Kurnool and Nalgonda facility to enable the plant to produce approximately 7 megawatt and 4.1 megawatt respectively from the waste gases generated in the manufacturing process. All the electricity generated by this unit is consumed at the plant itself. In addition to this, we have upgraded a cooler in our Nalgonda plant at a cost of 156 million rupees to achieve energy efficiency. Further, as discussed in previous slides, we are undertaking technology upgradation at our Kurnool facility to improve the power efficiency. On a positive note, we have seen increased market demand in the states of Telangana and Andhra Pradesh as compared to previous quarter, and we anticipate this demand continuing throughout the year due to infrastructure and housing projects. Moving to slide 12 on debt and liquidity position of the group. At the end of second quarter of 2018, the gross debt is $1,126 million, including $56 million of working capital debt. The company continues to utilize the working capital facilities due to increase in the quotations of raw materials. At the end of June 2018, the company has $429 million invested in its working capital requirements. Due to the refinancing executed in March 2017 and January 2018, the average interest rate has fallen to 5.3% compared to approximately 7.6% a year ago, and the company has extended its first maturity date of its long-term debt to January 2025. The company ended the quarter with a net debt position of $1,007 million with a cash balance of $101 million on the balance sheet and unused credit limits of $150 million. The company is comfortably placed to meet its obligations and continue to make the required investments to meet the market demand. Due to the overall increase in quotation, the net working capital invested in the business has increased from $396 million as of December 31st, 2017 to $429 million as of June 30th, 2018, an increase of $33 million. Although net working capital deployed in the business has increased by $33 million, there is an increase in working capital loan only by about $6 million. The company has minimal scheduled repayments for the next few years, as the majority of debt repayments are not due until 2025. Repayments of $21 million are scheduled during 2018 and another $40 million over the next 4 years. However, the company has the flexibility to accelerate debt repayments through the prepayment of Term Loan B after meeting the working capital requirements and the capex spending proposed for the expansion projects. Thank you, and I will now turn the call back over to Jerry. Jerry?
Thank you, Sridhar. Before we open the call to Q&A, I wanted to provide you with a better understanding of the importance and widespread use of our carbon and advanced material projects on slide 13. While our contributions to steel and aluminum production are well known, here on slide 13 you'll see that the average automobile wouldn't exist without the many applications made possible by our products. Everything from the frame and tires to the plastics and paints and the interior. And the car is just one example of how the raw materials that we produce make the products you rely on possible. As an investor in Rain, you should take pride in knowing that you too are helping to make these products possible. With that, I will now hand the call back to the operator for question and answer period. Over to you, operator.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their question to 2 per participant. If time permits, you may join back to the question queue for any follow-ups. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Sanjay Jain from Motilal Oswal Securities. Please go ahead.
Hi. So my first question is on slide 6, where you mentioned about Marple update. And can you help me understand how does this equation work with the tightening of sulfur norms? Why do you think that green petcoke supply will go down by about 900 KT?
Jerry?
Yes. It's not necessarily that petcoke production in general will go down, but ultimately the quality of petroleum coke produced, it will have a deleterious effect because more heavy cuts from the refinery will ultimately end up in the coker units. So this could impact essentially the composition and quality of the cokes that are produced. We're not necessarily, trying to assert that less petroleum coke will be produced, but it is the quality and suitability for calcining that could be impacted here.
So, does it pose any risks to our sourcing of raw material, and will it lead us to reduce our production if this comes true? I mean, should we read this as a negative for our risk to our business, or can we pass through these all additional costs if there are? And I mean, how will it play out if such a situation does happen?
If this was something that was a true threat to us where we were concerned about the business, we would tell you in plain words that it's a concern to us and a threat to our business. What we're alerting you to is that essentially this is taking shape. And overall, when we look at it, yes, it could impact the calcinable coke that's available globally for the global calcining industry. At this point, we've talked to our refinery suppliers. We have not any information that's saying that it's greatly going to impact them. But behind that, we also because of the flexibility, because of our ability to scrub sulfur, to consider to take more marginal cokes, competitively, we actually like the position that we have related to this because if it does affect the overall supply, we believe that we will have a competitive cost advantage in the cokes that we can use as raw materials for our process. But we are not saying that it will have an impact on essentially our ability to run our kilns and or our ability to run at full rates as a company.
Okay. Another question generally on the CPC market. How are the margins trending from here? Should we expect some compression in margin as the cost of GPC catching up in the profit and loss account? Or all the incremental cost has already flowed in, so these kind of margins, we can expect to sustain. Any sense on that, please?
Yeah, good question. We were concerned, and I think it's a follow-up question to really the last quarter call, where we said, we were going to be very careful about about producing at full rates at the expense of higher costs for our raw materials, that we were focused on protecting our margins as a business. We did cut production and essentially protect our margin in the second quarter as GPC costs did continue to rise on us. However, for the third quarter, we're more comfortable with the way that the price increases have moderated. We're still finalizing some of our finished product prices, so I can't make an absolute statement on margin at this point. But we're comfortable with the fact that we have seen surging GPC prices moderate and really level off, which is something for us that was a concern. And we're not necessarily concerned about our GPC price running aggressively up against our selling price.
This is useful, but I'm not very clear. One thing I want to know is that whatever is the current market price of GPC and what is our expense of GPC cost in the quarter ending 30th June, is the current price of GPC in the third quarter going to be higher than the price of GPC in the second quarter?
Look, we cannot give you that much of a guidance. But what we are saying is we will try to protect our margin to the extent possible to try to minimize the green coke prices and at the same time to try to improve on the calcined coke prices. That is our endeavor. But we'll try to protect the margin to the extent possible, and that comes in various forms. We have a lot of tools, so we will try and see what can be done.
I was just only expecting a directional, sense on this.
We cannot get that because our margin. Okay, Jared, go ahead.
Yeah, I did explain directionally. We were concerned in our call regarding first quarter results about GPC prices increasing, and they did into the second quarter. In the third quarter, we have not seen that. We have seen GPC prices for the most part leveling off, and we're comfortable with our costs during the third quarter, and so we're not concerned about the costs running aggressively on us where we were in the first half of the year.
Thank you. Mr. Chen, may I request you to join the question queue for any follow-ups, as we have several participants waiting for their turn.
Yes.
Thank you. The next question is from the line of Arvind Kothari from Niveshaay. Please go ahead.
Hello. Congratulations for the great sets of numbers. I just wanted an idea on the overall cash position of the company. So we have CAPEX lined up around $145 million, and roughly a maintenance CAPEX around 55, I believe, would be there next year. Coupled with, we have maybe, $73 million of interest payments. So currently we have around $100 million of cash on our books.
Your audio is breaking, sir. May I request you to use handset, please?
Just a second. Hello?
Yeah, please go ahead.
Is it?
Yeah, this is better.
Yeah, I wanted a clarification on the overall cash position of our company with the maintenance and the fresh CAPEX that we've announced. We have a cumulative CAPEX lined up of $145 million. Roughly the maintenance CAPEX would be... Hello?
Yeah, that's fine.
Yeah, maintenance CAPEX of around $25 million, and plus we have interest repayments which would amount to around $73 million. So roughly we would be requiring close to, 1,200, 170 million of, cash, and we have 100 million of cash on books. So with that 70 million of deficit would be through internal accruals, or we plan to utilize the working capital limits or take fresh borrowings?
See, as of now, whatever capital project we are announcing, our idea is most of these capital expansion projects will be met out of internal cash accruals. we don't intend to make any further borrowings, and the 100 million cash is as on date is available, whereas the capex, whatever we announced, will happen in a phased manner till mid of 2019 or end of 2019. So because of that, we are in a comfortable position and we don't expect to borrow any further debt.
Okay. So, sir, we were having close to 100 million of cash in the December, quarter itself. And in these 2 quarters, we've generated healthy cash flows. Still, the position, remains the same of the cash. So it is that some part of it has been utilized in the working capital as has been highlighted. The other part has gone into fresh capex, or I wanted to get a sense on that.
We have also paid $40 million of debt. Debt has been paid, about $40 million or about has gone into the working capital. And then some portion has actually gone into the capex. So we are using the funds only for the operations phase. And the balance and we have cash. So that is the reason why you are seeing a difference between December and June.
Okay, got it. And my second question was regarding CTP realizations. So we had a very good realization on our CTP, distillation products. This quarter it has, come down a bit. So the reports of the global agencies like, CTU and all, they highlight that the CTP prices in Europe are still firm and in fact increasing. What can be the possible reason for our CTP, realization going down this quarter as compared to, the March quarter?
There's a minor reduction is there. That is partly because of appreciation of dollar against the US dollar, against euro.
Okay.
So in dollar terms, you are seeing a minor decline, but otherwise there's no major decline in the CTP prices. Actually.
In euro terms, okay.
Yeah.
Got it. Thank you. Thanks a lot.
Thank you. The next question is from the line of Jimesh Sanghvi from Principal AMC. Please go ahead.
Hi, sir. Can you share with us the kind of inventory that we maintain on the GPC side per se? And also you said that the prices have started moderating. So if you can just share from which month have the prices started softening?
If you look at the slide 12, we are given the working capital position. We have about 25,460 million rupees of inventory.
Right.
Almost 2,500 crores of inventories we are holding. And in general, because the Indian plant, the CPC plant in India, the lead times for getting the materials is on a higher side. Our US plant, we get most of the raw material within US, and even the coal tar pitch distillation plant also, most of it is procured in the local market. But whereas in India, most of it is imported, we maintain higher inventory. Something like about 3 months is what we maintain as inventory.
Okay. And when have we started seeing a price correction on the GPC side or the softening of the GPC prices? Is it from June or probably more closer in August?
Jerry?
Okay, yes. What we've seen is the prices leveling off. Essentially, prices were, because the CPC price had zoomed up, there was a bit of a delay. That was all in the first and second quarters of the year. Now we've seen them flatten out, which is a good thing. They're not increasing because the CPC price has not continued, sales price has not continued to increase either. So the comfort we're deriving is that the overall we can control and protect our margin, which is the sole focus that we've been explaining over the last couple of calls.
Fine, sir. And so lastly, if you can just guide us somewhere on the volumes front, we have seen a good volume growth this quarter. So how does the demand per se look like over the next 6 to 9 months on the carbon product side? If you can also share that. And on the engineering product side, what has been the key driving factor for the volume growth in the advanced materials segment, if you can throw light on that as well.
Yeah, I mean, the business overall is not, this is not a consumer product type of business. So it's simply staring at the volumes and saying that the volumes will continue up, or it's indicative if the volume's down in a particular quarter versus another is a sign of weakness. There is ebb and flow to our sales pattern on the carbon business because of shipments, because of product mix, and so that is not what you want to look at. Is essentially our volumes over an annual basis on where we're going. There's nothing that's happening in the markets. While we don't provide any forward guidance, there's nothing that's happening in the marketplace that causes us concern related to volumes going forward. The second quarter was a good, strong a good, strong quarter for us from a shipment perspective. Obviously better than the first quarter was. And that's why I say is you can't essentially judge the health of demand based on a quarter-on-quarter type of scenario. But I give you the general observation that there's nothing that we're worried about from that perspective. Overall, the aluminum industry demand has been consistently strong, while the U.S. restarts in particular have been slower than anticipated, which means there won't be as strong a demand domestically for CPC as we had expected. Overall, it's not an indication that there should be concern about our overall sales going forward.
Fine. And sir, on the engineered products, if you can share your thoughts. Yeah, on the engineered products, we're just again in setting up that advanced material segment for us. That is right now the strongest segment from a growth potential perspective for us. The strongest product line, the engineered products for us that we have in the advanced materials segment. So overall, it is something where we get stronger demand during the warmer weather season as well, because of some of the sealers that we sell in that business as well. So it's very logical that the second and third quarter will be stronger for us from an engineered products perspective, rather than the first and fourth quarters would be for us. And you'll see some of that cyclicality because we're reporting in these different product segments in greater detail now. You'll see that seasonality come in that business as we report going forward.
Thank you, Mr. Sangvi. May I request to join back to the question queue for any follow-ups? We have the next question from the line of H.R. Gala from Finvest Advisors. Please go ahead.
Hi, congratulations for good set of numbers.
Thank you.
Hello. Yeah.
Thank you.
Thanks.
Regarding this Supreme Court order banning the use of petcoke for fuel, to what extent can we get impacted because of that? Are the things clear now?
See, we do not use petcoke as fuel. We actually use it as a feedstock. Okay. So we have gone back to the Supreme Court requesting for a clarification on this, and we hope to get some feedback quickly. And we will keep the markets informed as soon we get the same. But the ban is only on the imports, and we actually have 3 months of inventory at our site. So it's not going to have any immediate impact on us. But meanwhile, very soon we expect to get a clarification from the Honorable Supreme Court on this matter, because they have already permitted 4 industries using feedstock. There is no issue. So we are actually one of the companies actually we use it as mainly only as feedstock actually. So we do hope to get that clarification quickly.
Okay, but say for example, if the Supreme Court...
Yeah,
if the Supreme Court does not give clarification...
Sorry, go ahead.
And our inventories get exhausted, then are we in a position to import, or could there be any punitive action or something like that?
So technically, if we have any issue, then basically the entire aluminum industry, India also will have to shut down along with us.
Okay.
So it is not as simple as just we shutting down. It's going to impact the entire aluminum industry because there is no other source of petroleum coke. If we cannot import, then they cannot import, which basically means there is no other alternate source for getting petroleum coke. So it is not a simple matter.
Yeah,
so I'm thinking that Supreme Court will give due consideration for all these factors and then take a decision.
Okay.
Yeah, let me elaborate on what Jagan just said to help you understand the comfort and confidence we have that we'll be successful in this with the Supreme Court of India. We, as Jagan rightly said, we do not consume the petroleum coke, but we process it for the aluminum industry. In processing it, we burn only very little bit of it. But the compelling part here is as well that we scrub any SO2, which is the main polluting criteria here that they're focusing on. We scrub 99% of our effluent before we return the air to the atmosphere. So we have a very compelling story, very consistent with the four industries that have been permitted to use petroleum coke, even in industries that do consume it as a fuel. What the focus is here is on the polluting factors, and we believe we have a very compelling case that as they work through the details of it, they'll completely understand that we're a very responsible corporate citizen and, provide the allowance.
Thank you. We have the next question from the line of Bhavesh Shahan from IDBI Capital. Please go ahead.
So I just wanted to understand further on the carbon products EBITDA margins. I can see that EBITDA per ton has fallen by 15% sequentially to $110. Now I would like to know whether this is coming from CPC or CTP. I mean, which products margins have fallen most? I can see that CPC volumes have picked up for this quarter. So is it that we have increased the volume at the expense of margins?
Bhavesh, actually we don't calculate per ton margin by each product. We will only calculate the overall performance of the carbon business segment as a whole. So we don't monitor product-wise how much we are making. But in earlier quarters, when the prices are rising, there is some element of inventory gains are there. When the stabilization is taking place, it is only the converter margin or the margin enjoyed in the business alone is there. That could be the reason for moderation of the margins.
Okay. Thank you, sir.
Thank you. We have the next question from the line of Sureddy KR from Merchants India. Please go ahead.
Congratulations for a very good set of numbers.
Can you be loud, please, Mr. Sureddy?
Yeah. My query is with reference to balance sheet. I see there is an increase in goodwill from compared to December 2017 to compared to June 2018. It's almost increase of 324 crores. My understanding is there is no acquisition in the intervening period. Why this?
No, obviously, if there is any acquisition, we might be announcing about the acquisition. And if you look at the euro versus US dollar versus INR or euro versus INR, there is a substantial decrease is there, depreciation of Indian rupee is there. Like dollar is 64.46, it has increased to 67 rupees, and euro has increased from 71 rupees to 79 rupees. So, what all assets or what all goodwill we have in Europe or US, we are reinstating at the current numbers. So, because of that, there appears to be an increase in the goodwill, but not because of any acquisition, etc. Obviously, no acquisitions will be done, and even if they are done, it will be announced to the investors at large.
Is there any impairment assessment you carry it out yearly or quarterly?
We mandatorily we are supposed to do on an annual basis, and the auditors are supposed to check the impairment. But if there is any trend of like any signs are coming, certain major regulations coming, or a customer is being lost, or a technological change is happening, at the particular event we need to carry out an evaluation of goodwill impairment or asset impairment. We are not seeing any of them in the current period actually.
Okay. My last query is, our provision for taxation is still hovering around 32-33% of pre-tax profits. If the US is the corporate tax has come down to 21, are we providing for a higher provision, or I am missing something?
No, you are right. The U.S. government has reduced the tax rate from 35% to 21%. But we have operations in different countries. Like in India, we pay close to 36 to 37%. In Belgium, we pay around 29%. In Germany, we pay around 34%. So because of these reasons where the tax rate is high, our average tax rate is on a lower side, on a higher side.
Thank you, Mr. Reddy. May I request you to join the question queue for any follow-up? We have the next question from the line of Partha Johnson from NVS Brokerage. Please go ahead.
Yeah, hi, sir. My question is pertaining to the CPC basically. Just wanted to know how it has gone in the past couple of years and how you perceive going it forward.
Yes. On the CPC business?
Hello?
Can you repeat the question, please?
Yeah, I just want to know how the prices have gone for your product in the last couple of months, and how do you perceive it going forward for CPC and all the other products, basically for the carbon business.
Okay, on the carbon business, our over the last several months, over the last quarter, our prices have essentially moderated from their highs on CPC prices. As you know, over the last year, the CPC price has moved extremely dramatically up due to tightness of raw materials and industry capacity. And on the coal tar pitch business, the same thing is true, that the prices have gone up substantially over the last year and continued through the first half of the year on our coal tar pitch product. That is mainly the result of surging raw material prices during the first half of the year. So we were keeping stride with essentially surging raw material prices due to a global shortage of available coal tar for the distillation industry. On the other products, on our intermediate products, they move very much with the prices of the specific products. Whether fuel oil is a good indication, but we are tied to the price of BTX. Each of those products, we are tied to CBO prices and such, and they've all been pretty resilient during the first half. On the advanced materials business, those prices have fluctuated a bit. They were down a bit in the first quarter on the resins and modifiers business, but they since have recovered pretty much in the second quarter.
And how about going forward, sir?
Again, we're not seeing any major market corrections. Otherwise, we would be talking about that. The demand remains strong, and while we have a constant pressure due to the high prices for people wanting to reduce the price, we're not concerned of any dramatic price decreases over the next quarter.
Thank you. We have the next question from the line of Sameer Kapadia from Rockset Capital. Please go ahead.
Good evening. My question is, can you just let me know what is the current utilization for the carbon product business and the cement product business?
The carbon products business is actually operating at about close to about 80-85%, between 80 and 85%, depending on how the plants have been shut down for maintenance and other factors. About 80-85%, and the cement is operating at about 55%. 55%.
And in regards to the one follow-up question in regards to the U.S. tax reduction, how do you see it impacting on an overall basis? Like what percentage of sales come from the U.S. and how would we benefit because of the such reduction?
See, it is not about the revenues alone, but we also have to see where the interest and other costs are incurred. Our substantial, about 50% of the debt is in U.S. operations. While we don't have much debt in India, so whatever operating margin we make, it will add to the higher profits and higher tax payments in India. So because of that, though the tax rate is reduced from in U.S. from 35 to 21%, almost a 14% reduction in U.S. corporate tax rate. At a group level, it should be only about 3% maximum or 4% maximum. We could see a reduction in the effective tax rate.
Okay. Understood. Yeah, that's it from my side.
Thank you.
Thank you. We have the next question from the line of Vikram Sharma as an individual investor. Please go ahead. Mr. Sharma, your line is unmuted for questions. Please go ahead. Seems there is no response from the line. We'll move to the next question. That is from the line of Amit Agarwal as an individual investor. Please go ahead.
Hello.
Yeah, go ahead.
Hello.
Yeah, please go ahead.
Yeah, I wanted to ask about the overall, reduction in the cost, in the realization of our advanced material engineered products, because we are focusing a lot on that business. The volumes have substantially increased there, but I believe the per ton realizations have gone down. Any particular reason we were increasing the, volumes to reduce the prices, or any strategy of that?
See, basically, advanced materials is basically, that comprises almost about 200 products. And basically, it is the product mix. That they may be high, they may be low. We may be actually concentrating sometimes on margin instead of just the volumes. So because, and depends on the seasonal demand for the customers. So there are several factors. Overall, as rightly you said, as you mentioned, we are actually have a lot of focus on advanced materials, and we think that is the products of the future. But yes, you will actually see some slight changes from quarter to quarter onward, depending on the product mix for various reasons.
Yeah, two minor reasons is, one is some of the products, the raw materials what we use in advanced materials, they are indexed to crude, and the crude prices have increased substantially in June 2018 quarter. That has also contributed for lower margins. And the second reason is euro has been depreciating against US dollar compared to last quarter, and most of the costs are incurred in euro terms, and realizations are partly in dollar terms. So that also has contributed for a lower margin.
Thank you. The next question is from the line of Pratik Bajaj as an individual investor. Please go ahead.
Hello.
Yeah, Mr.
Go ahead.
Please go ahead.
Yeah, my question was pertaining to the overall winter shutdowns of the China, this second half. It is expected that the shutdown in the carbon side would be higher as a percentage than aluminum. So are we planning for a, second half production schedule to suit the, Chinese, plan? Also, if China is going to cut down on, production capacity of carbon in the second half, can we source a lot of GPC from China? Because then there will be a lot of GPC available in that country at a lower cost if their carbon plants cannot consume that.
we anticipate that we'll see the same pattern in China as far as the winter curtailments that we saw last year. And overall, if we assume the same thing, it means that smelters won't necessarily curtail their production that much, but that the largest impact will be on the carbon industry in China, meaning calciners, in reducing their production over the winter months. The larger impact may be that smelters may curtail their carbon plants, but not their aluminum production in large part. So we don't anticipate, much like last year, that we'll see much impact on aluminum production, but that on the carbon plant utilization as well as calciner operating rates. Again, that will be something that could be favorable for us, meaning that overall there should be more availability of GPC for us, in particular in India, as that happens. Although we don't anticipate that large an impact on the markets overall, much like last year.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. N. Jagan Mohan Reddy for closing comments. Thank you, and over to you, sir. I'm sorry, participants in the line for Mr. Jagan Mohan Reddy has been disconnected. Can you stay connected while we reconnect?
Yes. I will go ahead and provide the closing remarks. These are exciting times at Rain. As we described during today's call, our markets are strong, and we are optimistic that the global economy will continue to support the growth of our carbon, advanced materials, and cement segments. We have continued to strengthen our business by executing our strategic plan, which focuses on creating value for our shareholders and other stakeholders by maintaining the best-in-class operations across the industry and improving performance through operational excellence, functional integration, product development, and maintaining strong relationships with our global customers. We are making strategic investments in our carbon, advanced materials, and cement businesses, strengthening our management team with highly experienced and respected industry leaders. We are rigorously managing costs and carefully aligning our production with market demand and pricing so that we do not pursue capacity at the expense of profitability. And we are keeping a close eye on geopolitical developments that could impact our industry and our markets. And we are prepared to make necessary and prudent adjustments to maintain our global position as an industry leader. Above all, we are doing this while making safety, health, and environmental stewardship our first priority. Thank you all for your support, and we look forward to talking with you again next quarter.